Well, 2009 was a remarkable year. Considering where we were in the lows of March to where we ended up, it was unprecedented. And our portfolio of EVA investments performed very well. And we took advantage, actually, at the crisis lows to buy some fixed income investments at yields to maturity that we haven't seen in over a decade. The most important thing that we see coming out of 2009 is this chance for us to collectively, as a nation, catch our breath. And the reason I say that is because the next most comparable period being the Great Depression, really, that never happened. When the stock market started to go down in 1929, it went down for 4 straight years. Essentially, it crashed year after year after year. And it wasn't until early 1933, when FDR effectively removed us from the gold standard, that we saw a bottoming in the price level and indeed a slight rise, which gave the ability for a more sustainable recovery and built a foundation. We've seen that policy response much earlier, of course, and the price level has indeed stabilized and gone up. But by the time 1933 rolled around, nominal GDP had contracted by 45%, and the absolute level of debt was down by 20%. And we've seen nothing like that. There's a tendency to assume that we're into a conventional recovery and that the policy response has worked so far. But considering that we're still at 400% of debt to GDP, extreme all-time highs, that gives us cause for concern. I mean, at the beginning of the Depression, that ratio was 200%. And indeed, the ratio that we have today has doubled in the last 20 years. Coming out of recessions, we've never seen a contraction in credit. And that expansion of credit is so vital to kickstarting the next stage of growth. If you look back to '91, credit was growing at 1%. It was the closest we've come to deleveraging since the Depression. But in '82 and '83, credit and debt levels were expanding at 5 or 6%. And the same goes in the '70s. So there was significant room for credit expansion, and indeed did kick off a recovery. But this is quite different. Once the debt structure starts to go into liquidation, it carries with it many risks. We see a transition from an appetite to take risk, especially in personal financial matters, to one towards risk aversion, and we may well swing to the extreme of risk aversion. But I think we're very early in this process, and you can see it developing. You can see the savings rate starting to turn up, and household ownership of treasury bonds started to turn up. This is the moment when you should start to see some job creation. And we're concerned, considering that we've lost or underproduced 10 million jobs in the last 2 years. And with housing prices down 30% and equity prices indeed down 30%, even with this bull market we've seen in 2009, it's put extreme pressure on debt to equity ratios. So even though it always looks bad at the bottom, if we don't start to get some lift, confidence could be well be shaken. Our investments are focused very much on cash flow return and cash flow yield. Of course, we're talking here about solid dividend yields and good fixed income securities. Indeed, the companies we're looking to own are very close to their customers' pocketbooks. They produce things that people need to buy and need to spend money on. And you can even look at select technology businesses where returns on capital are generally fairly high. And in this environment where revenue growth may be limited, productivity enhancement becomes very important. This is not a time for us to be speculating and just buying the broader market. That may well come when we have this transition period to more risk aversion and people become more cautious. That may allow for people who are willing to speculate to find better returns, but it's too early yet. Our goal here is to protect the wealth that our clients have and try and earn a reasonable cash yield in this period of great uncertainty so that we can come out the other side and have better opportunities and they are secure. And so far we've accomplished that.